Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, August 21st, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, will the BLS annual payrolls revision jolt the U.S. economy into recession? Will the Fed minutes signal anything new? Our answers are the BLS's benchmark annual payrolls revision is unlikely to jolt the U.S. economy into recession. The business cycle is a collection of interdependent processes that are currently aligned in a moderating upturn. Investors should only proactively prepare for a near-term recession when our model signals an accelerating downturn across the preponderance of persistent leading indicators of the business cycle. That is not the case today. We expect the Fed minutes to provide clarity about how the Fed views the rising real policy rate, which should help set the stage for rate cuts. We also expect there to be some discussion regarding the pace of balance sheet runoff that can get investors excited about a further reduction in Treasury runoff, which is currently $25 billion a month, by year end. We've been highlighting the Fed's asymmetrically dovish reaction function since we authored our Jay wants a soft landing theme in early November, and reducing fake QT at such ample levels of reserves is supportive of that view. Transitioning to our 42 macro dashboard, as always, wrapping up with a question from our community. This one's regarding market implied odds of recession. So it reads, team, how does JP Morgan calculate the market implied odds of recession for equities? Screenshots below. Are these metrics useful gauges of sentiment, and do they have predictive power? I assume they're using credit spreads for the debt instruments, but not sure what the math looks like for equities and commodities. So phenomenal question. So I'll start with addressing the first question. So obviously I'm not privy to how JP Morgan has structured this model, but generally speaking, models like these that are just trying to assess probabilities of certain outcomes are usually taking the current observations relative to some observed mean or median of the time series, either on a levels basis, i.e. like what the level of the equity market multiple is, or on a rate of change basis, i.e. what the change in the equity market multiple is, on a percentile basis or some other normalized metric relative to some the observed median or mode or mean of the time series, relative to prior business cycles. So that's how a model like this would function. Again, I'm not privy to what they're using for their particular indicators here, like the actual features, but that's generally how models like these work. So just be aware of that. And then number two, are these metrics useful gauges of sentiment, and do they have predictive power? So I would say yes, they're useful gauges of sentiment, but no, they do not have predictive power. You can't use a market model to tell you if you're in recession, because by the time the model tells you you are in recession, the crash has already happened. I mean, go back to the fall of 2022 when models like these were all saying the U.S. economy had 100% probability of being in recession, and obviously the market had already crashed. You had already seen a significant reduction of capital from those types of markets. What you'd be better off doing is understanding how the business cycle actually works, and then focusing your attention on the persistent leading indicators of the business cycles, but specifically the ones that lead the market cycle. Not every data point you talk about here as investors on a daily, weekly, monthly, quarterly basis has predictive power for asset markets. Only some data points have predictive power for asset markets, and obviously our clients know exactly what those are because we report on them whenever they're reported on a daily basis in our leadoff morning note, and obviously we amalgamate all those insights into our monthly macro scouting report. So I'll wrap it up there. Darius Dell presenting our macro minute for Wednesday, August 21st, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.